Hi there. I'm Kent Kramer. I'm the Chief Investment Officer with Foster Group with offices in West Des Moines, Iowa, and Omaha, Nebraska. And this is our bi-monthly Financial Perspectives. This edition of Financial Perspectives is a special one because it's the first time that we've had a guest. Our guest today is Daniel Wallick from Vanguard. Vanguard is one of the largest asset managers in the world, and we are fortunate to have Daniel with us. He has a lot of experiences that you'll hear when I introduce him in our conversation. We had such a good conversation that we split it into two parts. This first half that you'll hear today centers on interest rates, inflation, and the bond market. And that conversation really has a lot of interest for people who are thinking about what part bonds play in their portfolio today, and what do interest rates or potential inflation have to do with that. I think you're going to enjoy this conversation with Daniel. So here we go. So Foster Group has had a long relationship with Vanguard, and they're one of the largest money management firms in the world. Obviously, they have a lot going on, a lot of people who work for them. They're not only a great producer of investment products, but they really produce a lot of great research, and they consult with firms like Foster Group. We've benefited from their advice and their wisdom over the years. So we're really glad today to have Daniel Wallick with us. Daniel's actually going to be the first guest on our bi-monthly Financial Perspective. So we're glad that he's braving that assignment with us, but we're super glad to have him. Daniel has had a long history with Vanguard. I'm just going to read a couple of things that you've done, Daniel. I know you're aware of these things, but I want to make sure our audience knows. He's a principal with the investment strategy group there at Vanguard, and he's head of the multi-asset portfolios. During his career, he's been at the forefront of a lot of different innovations. One that we'll talk about today is this idea of asset allocation and what should be in the portfolio. He's also named in conjunction with a patent for the managed payout funds. That's pretty cool, I think. The intellectual property has been in the news lately. And he's also been very involved in the creation of Vanguard's target retirement funds and the alternative strategies funds, among other things. I'm sure we could make a longer list there for Daniel. He has a BA in history from the University of Pennsylvania, and I'm talking to a Harvard MBA today as well, so I'll try to be on my best behavior. And try not to say anything that sounds too ignorant. But we're just excited to have Daniel here. So thanks, Daniel, for joining us. And we're going to jump in talking about things of interest to our clients. I know I'm sure you're hearing a lot of the same kinds of things.
Sure.
One of the things that we've enjoyed with Vanguard for a long time has been using your bond funds. They're enormous. And obviously, you guys are a big player in the bond market, so you have lots of thoughts about that. So the environment today is kind of interesting with interest rates being very low. I know there's a lot of questions about, hey, with this low interest rate environment and the potential for inflation, what is Vanguard thinking about bonds and the bond market generally now?
Right. Well, Kent, thanks very much for having me. I really appreciate the opportunity to share some time with you and talk about this. And before I was at Vanguard, I was in the fixed income market for 10 years too. So this is going home for me. So I appreciate that opportunity. When we think about bonds in a portfolio, there are really two key elements that we think about. One is ballast, and the other is potentially the way people think about income. So let's just talk about both of those. So the key role for me of bonds in a portfolio is when we think about it, ballast relative to the riskier assets in the portfolio. So one could have a 100% equity portfolio, but you're living with a lot of volatility. So the reason often that we add bonds to that is to add some balance and to keep us invested. I think of it during the dark times of the investment space when it sort of smooths out the ride. An example of this was, just last year, right? There was a huge decline in a moment. And I will tell you, I've talked to clients who, despite advice against that, pulled all of their money out because they thought the world was going to come to an end, right? And it's in part probably because they didn't have some bonds in their portfolio. So the role of bonds is to steady the performance and the consistency of the result to allow us to stay invested and to not make bad decisions at the wrong time. That's the primary role. I would say a secondary role that some people use, my 89-year-old mother is in this category, is they value the cash flow off the construct off of the coupon as a way to think about managing expenses. It's sort of a mental accounting function. But for some people, that's a secondary function that really it's helpful, right? It sort of structures the way they think about their assets and their income. So that's a secondary function. Less mathematical in that second one, but still, I think it has a sort of an emotional impact and sort of behavioral role. So but the first mathematical one is really ballast. And that remains, despite all of the low yield environment and everything else. That continues to be a core sort of strategic objective we talk about all the time in portfolio construction.
So with kind of the lower rate environment they're in right now, I mean, obviously the need for ballast in a portfolio, it kind of never goes away. As you've said, we want to have that downside protection. There's a diversification, huge diversification benefit, obviously having bonds in us with a stock portfolio as well. But the second one, so the income portion of that, people look at rates and go, well, I'm not getting much in terms of income depending on the bonds. And then there's kind of a concern about inflation as well in terms of how that might affect bonds going forward. What's kind of Vanguard's view in terms of how this low rate environment and the potential of inflation, does that change anything in terms of, you know, what the exposure to bonds would look like for an investor today?
So let's take those like in order. We'll deal with low yield environment, and it's an irony to me about low yield environment. 4 years ago, I wrote a chapter in a book about low yield environment, right? And we're still there, and it's been persistent. So I think it really comes down to what is the strategy, what is the objective of the portfolio you're trying to achieve, and has that strategy changed? Or what is your objective, right? Because if your objective is a level of return, then there's the consideration of, do I change my asset allocation to achieve that level of return? On the other hand, as most investors are, it's a total return approach. And the total return approach is, I'm trying to trade off risk and return and look for what's the right combination of that for me. To the extent that you're a total return investor and your objectives haven't changed, then your asset allocation in theory should not change. It's pretty much the same. So those are really two different ways of thinking about it. The second part of your question was around inflation. And this, I think it's a great insight, right? Because we're getting this a lot, and you see it in headlines. I just saw it recently in a headline where there's concern about chip capacity in the United States and the ability to build cars and everything else because we don't have enough chips. And then on a personal note, I tried to book a vacation, and I realized, I'm about, 9 months too late for that. I'm finally figuring it out. And, I don't know if anybody's looked at that, but it's hard to find things and they're all really expensive. So people look at that and say, oh, is there a supply and demand problem? Is this going to lead to inflation, right? Because it's one of the sort of the core sort of classic reasons and why prices go up. And when I talk to the economists in our group, to a man and a woman, they all say, listen, this is a temporary thing. We have to digest this, right? There's a lot of pent up demand in amongst consumers. And the supply chain, had some modest disruptions before. There'll be a digestion period, but we don't see a long-term impact for sort of a massive increase in inflation to do that.
Okay, that's helpful. I know there is just a lot of information flowing around out there in terms of people's views. And at Foster Group, we try very hard not to be in the prediction business, but it does help to be prepared for a variety of outcomes, and certainly the possibility of inflation, whether it's a short-term pop or maybe a little bit longer-term trend, it's there. But sometimes you just have to keep thinking long-term in terms of that investment allocation and what you're really trying to do.
Well, Kent, I think it's a really interesting thing, right? So let's walk through that scenario, right? If somebody has a concern about inflation, one can build a inflation-protected portfolio, right? It'll probably include tips on the short term, could be equity, REIT, something on the long term. But it's like any insurance policy, right? It's going to cost you something to do it. And the question is how important is that to control? I will say the secondary function, when we've thought about inflation, we think of it as a box, right? You can it's short-term, long-term, expected, unexpected. Mm-hmm. What tends to hurt people is short-term, unexpected spikes. That's the jolt, right? And that's where short-term tips can control for something. That's a pretty efficient market, and so you're paying sort of a premium for that protection in many ways. Longer term equities or riskier assets, commodities, other things can help carry that. It's often like, what type of inflation are we talking about that we're trying to protect against?
Yeah, it's funny. I just wrote about that this morning. I had a question from one of our advisors from a client, and I said, well, if they're really concerned about inflation, everybody else is too. So in some ways, the market kind of reflects that concern. But if it's really an unexpected inflation concern, then those short-term tips really, like you said, it's an insurance policy. You're going to pay a premium for that. And if inflation is significantly more than what kind of the market expects, then you do get that quick adjustment in return based on the quarterly inflation number. But
and that can help you if you, particularly if you're going to have a cash flow concern, right? If it's long-term investments, I think through time will riskier assets will carry you. But if you're managing a business or you're managing a situation where short-term cash flow is a concern, then you can be in that, it might have a role or could have a role.
Yeah, that's good. So anything else before because I've got a couple other questions here just on kind of allocation generally and investor goals, but anything else on bonds before we kind of leave the subject? I know obviously it's a point of interest for lots of people, but
I would say, and you said it up front, but I want to clarify. I think there's a secondary important function here, which is a bond fund versus individual bonds. And they can perform differently. And one of the values of a fund is you have constant cash flow, so that spikes on rates often affect it less, right, than holding individual bonds, unless you have a big laddered structure, because you always have cash flow and you'll be reinvesting, and so that you sort of go up on that ride. So there is some value in the liquidity of a fund and the ability to manage rise in rates, because you're constantly sort of in the market and buying. Now you can replicate that with a really long, large ladder, and God bless the people who can do that. But for most of us regular folk, a fund really does help us in achieving that.
We've looked at that too, and it's just the cost of getting the level of diversification and to keep the bond kind of ladder refreshing at a regular rate. It takes a lot of cash flow, but it also gets kind of expensive just because the size of the purchases, as the size of the purchases gets smaller, the cost per bond just generally gets a little more expensive and it erodes some of that potential return.
And you get the liquidity. I mean, the value of funds, right, is you have liquidity.
Very, very
and if I look back on the biggest problems I've ever seen in investment space, it's the lack of liquidity, right? People just get squeezed and they have to liquidate at the time when they don't want to. And you really, that's the thing I counsel against. You got to be really careful about that.
That's a great point again for why to have bonds or other kind of less volatile assets in the portfolio and diversified assets, so that if you do have a cash flow need, and equities are down, there's a place to go for that liquidity as you need it. It's the way the portfolio gets designed. So absolutely great point. Great point. Daniel, thank you so much for joining us today. This has been great. I think I'm sure we could find lots of other things to talk about, and hopefully we'll do that in the future. But for now, again, just thank you very much for joining us. And thank you for people watching today. We're glad to have you joining us with our Financial Perspectives videos. Again, we put these out bi-monthly, and if you're interested in making an appointment with a Foster Group advisor, we'd love to have that conversation at your convenience. So Daniel, thanks again for joining us. Be well, and we'll see you all soon.
Thanks, Ken.